Okay. Okay, you guys are on.
Okay, so we'll have half an hour. So at the 28-minute mark, I'll say, okay, this is wrap up. What? Any?
Turn off all cell phone noises and-
Okay, thank you. In 2013, gold had its worst return in 30 years, and the consensus is that the economy has never been better, as stock markets are hitting all-time highs, and gold has continued to underperform. Our next guest, Derek Webb of Permanent Portfolio Solutions, says gold will shine again and definitely has a place in a diversified portfolio. Welcome, Derek.
Thank you, Paul.
Derek, you've joined Permanent Portfolio Solutions, a division of Bully Management Group. Tell us why you made that move.
Well, Paul, as you might know, my previous career, I was more of an equity stock picker. But what I realized in 2008, what I believe very firmly going forward, is that macroeconomics are going to play a much more significant role in investing. Meaning, historically, my job was to produce alpha, to outperform the market. But that also assumes that that's a good thing to do because the market's going to go upward and to the right. But if you look very clearly, we're having these very large cyclical corrections. Obviously, we had one in 2008. We had another one in 2000, and my guess is we will have many more going forward. And that's, to me, a function of the fact that the federal government is basically controlling the economy and controlling the Federal Reserve. Obviously, it's highly indebted, and unfortunately, macroeconomics are going to play a much bigger role. So rather than just produce alpha, I think portfolio construction is going to be much more important for growing and conserving people's wealth going forward. And this permanent portfolio idea, I think, is one of the best ways to do that.
Okay, so having said that, are you abandoning your stock picking and your, I guess, momentum technicals background?
No, so I am still a huge believer in technicals. I still believe that momentum investing is one of the best ways to invest for equities, or technicals is one of the best ways to invest for bonds. But having said that, we needed to find ways to hedge out the equity exposure. So let's just say the market's correct 50% this fall, which nobody thinks could happen, but certainly could happen, and nobody thought it could happen in 2007, and nobody was really aware of it in 1999. We need to find ways to hedge that out, and that's the gold component of the portfolio that does that.
Okay, so let's talk about gold then. How does gold work in a portfolio?
Well, basically, Paul, the interesting thing is most people understand, let's say, gold bugs or people who understand gold understand it as a great investment during negative real interest rates and or printing of money, of course, which we have both right now. And so that's one reason why gold should do well and continue to do well. However, the thing that most people don't understand about gold, which I didn't understand until I started doing a lot of research, is that gold is also inversely correlated to equities when equities have significant corrections. So as I just said, one of the problems is that we're probably going to continue to have these massive macro corrections. And so the question is, how do you hedge yourself? The only three ways that I know are being short equities, so you have to be in a hedge fund, being long the VIX, which is very, very expensive, just it's the way the forward curve is on the VIX, and or being long gold. So gold's a great way to hedge your equity portfolio out. It's a great way to take the risk out of the portfolio when we get these big corrections, which I think we'll probably do for one very soon.
Okay, so let's go back to that macro then. It seems like in the last 10, 15 years, we've had three major corrections when previous to that it used to happen every 20 years. What's going on worldwide in the financial system that these corrections or these financial meltdowns are occurring with more frequency?
Right. So this is just, of course, my opinion. Though I studied economics, I'm not an economist. Though actually that probably makes me probably know more than everybody else. Actually, if I was an auto mechanic, it'd probably be even better. But very simply, my view is that we are been running the economy for the last 30 years on the creation of debt. And debt could be either at the personal level, the local level, level, the state level, or the federal level, or the corporate level. So it's a very simple fact that every unit of GNP requires something like 3 to 5 units of debt right now. So effectively, you're just financing growth. So as your balance sheet balloons upward, if you think about it like an equity, a company, if a company has a lot of debt on it, it means the equity is very, very volatile underlying. Because what it means is a very small change on the top line, as in change in GNP or change in sales, has a very dramatic change in the bottom line. And I think that's really what you're seeing. It's just that as we're more and more indebted, and the only way to produce growth is by producing more and more debt or printing more money, it just means the system is that much more volatile. And so there'll always be these dramatic stops and starts, as we've seen over and over again, a lot of which is really just caused by the Federal Reserve or indirectly the governments of the world.
So getting into debt to get out of a problem caused by too much debt doesn't seem like a viable solution. How does this end?
Well, it's not. But remember, we're dealing with politicians, so it's not supposed to be. This kind of thing has gone on throughout history. You just have to be a student of history to understand why this goes on. I mean, I call it the normal evolution of a luxuriant society, meaning as society becomes more and more luxuriant, it wants more and more things. It doesn't want to pay for those things. You know, I did take economics both in high school and college, and there was a very famous book written by Paul Samuelson. It was the first book you got. It was about 4 inches thick, and you're in high school, and you're like, ugh. And it's filled with numbers, and, you know, it's pretty heavy duty for a high school student. And I remember the very first paragraph of the very first chapter. He said, economics is the study of the allocation of scarce goods and resources. He said a society has to determine the allocation between guns and butter, meaning can you have social programs and have a military? And of course, in the United States, we have both and have had everything for a long time. It's kind of like the Soviet Union before it collapsed. So the bottom line is I just think it's a normal evolution of any great society, whether it's Rome, the United States, etc. People want more and more. Government can't control itself. And yes, producing more debt just worsens the problem. Does not solve it, but it keeps you in power.
Okay, so let's. Why don't you tell us, the audience, a bit about the permanent portfolio? What exactly is it?
Yeah, so interestingly, the permanent portfolio is not a new concept. In fact, it's probably one of the oldest investment concepts out there. The first time that I have heard of it, or most other people, is there was a gentleman by the name of Fugger, I believe was his name. He was in Germany roughly in the 1400s. He was the wealthiest guy or the wealthiest family in Germany. And his concept for both growing wealth and maintaining wealth was to allocate a quarter of his wealth to the following 4 categories. That would be stocks and bonds, which we all know, cash, and then precious metals. And he always had all 4 categories. And one of the reasons that he did this, and one of the reasons that it works, is because each one of those asset buckets, if you will, performs positively under various circumstances. So stocks, if you have a high growth economy, do well. Bonds, if you have a no growth economy, do well. Cash does well when the Federal Reserve raises interest rates and slows the economy down. And gold does well if you have monetary abuse or inflation. So it's interesting, if you just take that very simple concept and then you say, okay, I want to apply that going back in history from today, and as far back as you can realistically go is 1971, because that is when gold became a free asset, meaning it was decoupled from the dollar, i.e. the US dollar went off the gold standard. What you see is that, in fact, it works as well today as it worked back then. So very simply, over that basically 40-plus year period of time, if you had those 4 components put together, they had basically done what the stock market has done over that 40-year-plus period of time. Excuse me. But they've had 1/4 of the volatility of the stock market and have never had the big drawdowns of the stock market. So what it has done is continue to grow your wealth at these very, very high rates, but because of the four components, it's reduced the volatility massively.
That's interesting. It's counterintuitive. One would think gold is a risky, volatile asset, but yet you're saying including the portfolio along with cash reduces risk, reduces standard deviation.
Well, what's interesting is if you look at the volatility or if you look at the volatility, very simple, or standard deviation of gold, you're 100% correct. Gold, out of all the assets, is the most volatile. So if I go back to 1971, the S&P did, I'm going to use just simple round numbers here, did 10% a year with a volatility of 18%. Bonds, and these are long bonds, did 8% a year with a volatility of 12%. Gold did 8% with a volatility of 29%. And cash did 7% with a volatility of 0 because by definition it's cash. Now, so gold is volatile, but the magic of gold is that gold, again, is inversely correlated to equities during periods of huge stress, not during normal periods. So if the stock market is up, let's make it up 5 or 10%, gold is not inversely correlated and it goes down 5 or 10%. It could go up 5, it could do whatever it wants to do. Stock market's flat, it could do whatever it wants to do. But it's very clear that if the stock market corrects, let's say 15 to 50%, gold goes up quite significantly. And in fact, if you go back over that period of time, in any year that the stock market was down, gold was effectively up, and it was up an average of 15%, which is pretty amazing when you think about that. So basically, gold is more volatile, but it's volatile at the right periods of time. And remember, volatility can be both positive and negative. So it's a statistic I don't like to use that much because you really need to look at is it volatile in your direction. Bottom line is, gold, when put into a portfolio, reduces the risk substantially.
Great. And how do you own gold? Do you own the physical? Do you own ETFs, closed-end funds?
Yeah, so in the portfolio, we're traditionalists. And if you read the book, and I would recommend anybody do it, called The Permanent Portfolio, you can just buy it right off of Amazon. It's a great book. We effectively run the portfolio very similar to the way that he suggests you do it. And the reason we do that is, the way I tend to think about gold is your insurance policy. So in other words, if everything goes wrong, if your federal government or your central bank is printing too much money and debasing your currency, which is what we're having, in my opinion, right now, you have gold in there, A, because it's going to do well, but B, it's also really your insurance. Think about it that way. It's your asset that's outside of the paper system. Remember, cash, bonds, and stocks are just paper. Gold is the only real money that you actually have. So if it's your insurance policy, you want to own the real thing, meaning you don't go out and buy discount fire insurance. Of course, you want the lowest price you can pay, but you want to make sure that when you need that insurance is going to be there. One of the problems with ETFs or some funds, not all, but many of them, is that they're not backed by the real thing. So if you were to need it, when you need it, you want to make sure it's there. So we own it physically. We're aligned, are part of a bullion management group. They actually have funds and direct investments in bullion where they have spent a lot of time and energy making sure that it's owned absolutely correctly, where you can get it at any time that you need it. And that is, in fact, the way we own it in the portfolio.
Okay. Now, if going back to something you said previously about corrections occurring every 7 years or so, or maybe I asked that question, and gold being a part of that portfolio at all times, wouldn't that be a drag on the portfolio, sort of sitting in the portfolio waiting until a stock market decline in order to do well or not?
Most hedges, to your point, so let's just think of gold as a hedge. Most hedges have negative rates of return, meaning if you short stocks, if you're a great short seller, of course, hopefully you'll have positive rates of returns. But if you go back and you look at statistics, in a rising stock market, of course, it's very hard to produce positive rates of return when you're short. So to your point, it's a hedge that costs you money. The VIX, and I've had a lot of experience hedging with the VIX, is a hedge that costs you money. And it's very expensive, works well when the market's correct, but it costs you a lot of money. And the reason it costs money just has something to do with the structure of the forward curves. Remember that gold itself has done as well as long bonds in the biggest bull market in bonds in history, and basically has done almost as well as the stock market. A year ago, it was neck and neck with the stock market, but now with this last big bull run of the stock market and, of course, a pullback in gold, the numbers are slightly different. But again, wait a year and it probably could have better returns in the stock market. The point is, gold is an asset that actually has done just as well as everything else. Most people don't realize that. So, in fact, it's a hedge that actually pays you to own, in a sense, is the way I think about it. So, no, it is not a drag on the fund in any way, shape, or form. Of course, like all assets, every asset doesn't go up every year. But over time, it has gone up. And that's in a pretty benign period for gold, in my opinion, meaning, given the financial state of the world currently, I would expect the rate of change of gold to be much more positive, i.e. much higher than it has been historically. So you have an asset that's appreciated just as much as the bond market, the stock market, should probably appreciate more going forward given the macro environment, and in turn is inversely correlated with equities during major corrections. So to me, it's pretty obvious that you want to have a lot of that in your portfolio.
Now, in previous interviews, you've thought one of the risks is rising interest rates. Is that still a concern?
Well, none of us know